Welcome back to the channel. I'm Osborne Foreman, and in this video I'm going to be talking about National Express stock. This was a paid request on Fiverr. The link is in the description down below, and this is by Mark. Mark has asked, he's a long-term viewer and appreciates the videos. I appreciate the support, Mark. He's on about how National Express is one of his biggest holdings, taking up 8% of his portfolio. He scooped some gains on it last year, maybe should have gotten out but have ridden it down. I'm a lazy / passive investor, says Mark, and I haven't thought too much about NEX beyond it having a good, if not dominant, market position. And I like their brand / service. I wonder as to the effects of Brexit and its rumoured purchase of Stagecoach. Any thoughts / insights would be helpful. And if you like the video, please drop one of these to help beat that YouTube algorithm, or even do one of these if you do not like that they've hidden the dislike button. When we look at the fundamentals of National Express, it's important to note that they are a lot more diversified than one may originally believe. They are located in the UK, Germany, Spain, Morocco, Switzerland, the United States, and also Canada. In terms of valuation, things do look quite promising on a price to sales ratio of 0.8 times. This means that their revenue is actually greater than their market capitalization or their total value on the stock market. However, this isn't without its negatives, and National Express stock actually has a negative price to earnings ratio, which suggests that they are currently unprofitable. However, on a price to book ratio, they are worth less than the industry and the market by quite a considerable margin, and so this could have a good margin of safety, providing this company is able to return to profitability. Speaking of profitability, obviously in the last year they have struggled. The lockdowns and subsequent other events of the pandemic have certainly meant that National Express has been in a sort of struggling position, but they've done well. Their revenues have declined by a significant amount, dropping by about £800 million from the end of 2019 to where we are in June 30th. I'm sure another update will be released quite shortly. And at the moment, as far as I'm aware, they are losing about £270 million per year, but this is likely to recover more, and we can see the free cash flow on the screen is starting to edge up, suggesting that they've lowered the operating expenses in the company and that they're able to effectively do better for the future. So in an important situation, it's good to check the financial health. The financial health of this business is, to be honest, a pretty decent quality. I was expecting a lot worse. Yes, they do have a fairly high debt to equity ratio of 84.3%, but they also have a fairly substantial cash position. This cash position at the moment is £465 million. Yes, this is roughly between 1/3 and 1/2 of their debt, but obviously, I think this is a good amount of cash to have, and if they need to, obviously, they can renegotiate their debt and do it for the longer term. Because don't forget, National Express is based on leasing. They obviously have a lot of leased vehicles, and that means that they have got these obligations at all times to pay. Their short-term assets do not outweigh their short-term liabilities, although, as I say, they could defer this, they could talk payment plans, they could dispose of some of their assets. They are in a strong position, that's for sure. However, with National Express in mind, you've also got to remember that they have something like 28,600 vehicles. This could be a depreciating asset, and so they may require more capital expenditure than that of the decreasing or depreciating price of the assets, such as their coaches and transit vehicles. As far as I'm aware, National Express did used to pay a dividend prior to the pandemic, and quite frankly, at the moment, it makes a lot of sense as to why they are not doing so. They are unprofitable, and meeting these demands is obviously not something you'd expect in this time period. However, prior to that, I would assume that National Express is a fairly recession-proof stock. No one could have seen the black swan event of the pandemic occurring when it did in 2020. And so other than that, I think National Express is well geared in future recessions. Say there is a credit crunch or something of the like. People are still going to need transportation, and National Express is in a very strong position to accommodate this consistent demand. For those of you that don't know, I'm currently providing a template that you can keep forever to track your stock investments. At the moment, it's tailored towards UK stocks, but improvements will be made in the future. If you're interested in this, I've got a Patreon. Take a look in the link in the description down below and check it out. If you don't think the benefits for you, that's completely fine, but I've put a price that I think is at a very cheap amount. £2 a month really isn't that much in my opinion, and I think for the value it provides, where you can see my portfolio holdings live drive and their performance in a day-to-day, even 15-minute basis, then I think there's a lot of value here. So if you'd like to join my private investing community, click the link in the description down below. Their management has been on an average tenure of about 4.5 years. They recently replaced the CEO about a year ago, and obviously because of the nature of this business, the ownership is very minimal for individual insiders, but it is by bulk held a lot by institutions. And in their most recent trading update on the 14th of October, this was released, I believe, then, they go all the way up to the 30th of September. So this goes a bit beyond the last results that we were seeing on simply Wall Street. We can see that they've actually had a sequential improvement in their performance, which has continued in Q3. Their revenue is up to 83% on the same period in 2019 on a constant currency basis. That is very impressive, and this is an improvement from Q2, which was only 76% better than 2019. You may ask, why are we looking at 2019 if 2020 was obviously the most recent financial year? Well, during the pandemic, the lockdowns have very likely had materially impacted the revenue of this company, and so it makes a lot of sense as to why you would be looking for 2-year like-for-like growth. It makes a lot of sense here, and some businesses that have artificially inflated in 2020 may also go back to 2019 as well, as it gives a more realistic and accurate figure of how well the company is doing. More data is good as long as it isn't too much information that you've got information, or not too much information where you might have analysis paralysis. But that is another story in a whole and doesn't relate here. Interesting enough that they're mitigating the rising input costs. This is payroll and fuel. This accounts for 70% of their cost base, and that their fuel is fully hedged through 2022 and into 2023. And they anticipate their underlying profit before tax for 2021 to be in line with expectations. But the important thing here is that they retain significant liquidity, which means they have a lot of cash available, and they have strong free cash flow, which could mean that this has somewhat improved in the last quarter compared to simply Wall Street. And in fact, they expect to close 2021 with around £0.8 billion in cash, or roughly £800 million, which, if we saw their cash position was something like £465 million at the end of their trading update in June. So this is a significant step up. More cash is certainly a good thing, and it allows them to operate with agility, and also allows them to not get caught in any short-term disasters that could be impacting their revenue, like for instance the idea of a further lockdown. Obviously the government seems to have ruled out the idea of further lockdowns, but they are certainly moving towards additional plans that may impact the revenues of public transport, such as enforcing masks. You may have some individuals that may not want to use the public transport for the sake of not wanting to wear a mask. This could be a very small minority, but it is something to always keep in mind. Interesting to note, in the UK, their bus patronage is now at 76% of pre-pandemic levels, but they had received some support grants which had ended in August, and that's now been replaced by a different grant which runs through to the start of, or the end of the tax year in April 2022. So they've obviously had some benefits from the government during these struggling times, and so you need to keep that in mind. Were they able to really provision for this kind of disaster, or were they really saved in a way by the government? This kind of emphasizes the strength of their business model, but then again, what kind of operator, be it airlines, public transport, or any form of operations, were going to expect a pandemic? It was very unlikely that they would have known about it, and so it makes sense as to why they've had government assistance. And obviously there are ongoing shortages of drivers across the sectors in terms of HGVs, so heavy goods vehicles, and this might even be more like security drivers, delivery drivers, and also public transport drivers such as buses, maybe even railway like train drivers as well. So there is obviously an ongoing shortage, and I believe this is due to perhaps lower wages for the reward involved in the job, and also I believe something to do with closed borders and not having workers from Europe, and that may be an impact following Brexit. However, this is something that is a little bit more out of my understanding, but I do imagine there are going to be some impacts about Brexit. Obviously, this is a diversified business that has their services across Europe, the US, the UK, and Canada. Important to note that actually I believe Spain is there where they have the second most amount of revenue, but we will check on that in just a minute. We should also mention that their corporate activity, they had announced that the potential all-share combination with Stagecoach, and this is particularly interesting because it effectively buys up market share. Stagecoach's results were released on the 8th of December 2021, which actually I think is the day of recording. So this is very relevant to this video. We can see that their profit before taxation is £18.4 million, meaning they are making money, although their margins are fairly low. And I think I can't see a percentage margin here, but we're looking at something like 1%. No, but maybe 1.5–2% margins on their money, but at least they are profitable, which is obviously a step up and something of an improvement. This, I think, is a good thing to look at. Stagecoach will have a different business model and different diversification in terms of revenue than the likes of National Express, but it is a good sign. Look, they are now starting to be profitable. Or they were profitable in the first half of 2021 as well, but only just. It's improving quite a step up. This could be reflecting well on the shares or on the company of National Express, especially if they're looking to acquire this business, in which the deal would be planned to go down on December 14th. So next week, as of this video, they're on about the merger has been extended. So the talks about this has been extended to December 14th, in which they're going to make a second bid for the business. I believe at the moment the general idea is that shares would be that National Express would hold 75% of the combined company and Stagecoach would hold 25%. So at the moment, I believe the share price of these two businesses are going to be quite closely tied together, and there may be some value in terms of arbitrage trading, because I can't say that word properly, where you could probably get some value between them, but this is not a kind of strategy that I would personally use because I am a long-term investor. But I do think, and it has been mentioned here, that the board and Stagecoaches continue to believe that potential combination would be strategically compelling proposition, delivering strong value creation for both sets of shareholders. I believe both of the managements of these companies like the idea of this merger, and this could be good. They're obviously getting more market share, they're getting a bit more diversification, perhaps more growth potential throughout the scale of their operations. And here we are, we can see the revenue breakdown by territory. I was quite surprised, and this is the annual report from 2020, so the revenues will be subject to have changed. And in fact, this actually is 2019 as well. We can see that the UK, and actually a lot of their revenue had struggled, so you can see a lot of it dropped down. But I was more or less surprised to see how much of a share Spain had taken up, because they offer a lot of their services there, and same with the US. So you're not just buying into a UK operator here, you're buying into a primarily US, then Spain, then UK, and some Europe places such as Germany, Switzerland. This obviously has well diversified revenue and is well positioned in some of the more mature, developed countries. That could mean that they're going to consistently generate revenue, although albeit maybe at a slower pace than that of a company in more of its youth stages. I do like to see the revenue breakdown by the business line. Again, the figures are likely going to be different now, but roughly as of this annual report that was for 2020, the financial year, we can see that student transportation in North America, school buses for instance, took up 28% of their revenue. Their urban buses that were in the UK, North America and ALSA, this took up 38% of their revenue. They had regional and long coach, which were haulage coaches, which is at ALSA again, and long haul. UK coaches took up 19% of their revenue. 8% of their revenue was taken up by other styles of charter, and 7% of their revenue was taken up by rail, which was in Germany, which is particularly interesting because this could be a market for growth in the future if they plan to expand further on the idea of this railing. And I believe actually I just missed a bit on that last page there. They are obviously trying to prepare for themselves, or at least at the time they recognized that it was an unprecedented year and that they were looking to perform as best as possible by doing the right things through the crisis, so they were ready to rebound and emerge in a better way. So they've taken notice of the work and commuting patterns, how that's going to change, perhaps from a more working from home environment. And they've also mentioned that the use of the high street, for instance, is likely going to adapt. We're seeing a lot more coffee shops, for instance, rock up in high streets. It seems like the high street is becoming more of a social location to be, and so that would make more sense as to the changes. We may even see a pickup in some forms of public transport in this way as well. And they've also mentioned other things like education-related travel. A lot of, at least universities, it seems like, are teaching via Zoom and online, so that's obviously going to impact the forms of public transport. So there's many factors in play here that could certainly change the demand and supply of this public transport needs by the public and other places. And obviously the government had supported their public transport. Unsurprisingly, that during the pandemic, obviously 40,000 of their colleagues were either furloughed or temporarily laid off during this time period. And as a company, they've obviously not been immune to the pandemic, and unfortunately had lost 32 of their colleagues as of this annual report. They do not expect to suffer any direct consequences to do with Brexit, as they do not run any scheduled cross-channel services. So obviously that changes what I mentioned earlier to do with that. But obviously I think they're looking more or less in the form of their services, whereas in the more of the macroeconomic scale, where obviously the UK may be struggling to get heavy goods vehicle drivers or large, I don't know what it's called, I don't actually drive these kind of things, but buses, lorries, coaches, for instance, trains, if they're struggling to get these, they're obviously going to have some form of material impact from Brexit. This could mean that they may need to rise wages to a higher level in order to entice more employees or provide more benefits to them, which obviously is going to be at a cost to their profit margins, but I'm sure they have likely bigger worries at the moment. I quite like the business model of National Express. It's resilient, it's got a market cap of £1.5 billion, and obviously if this is expected to be about 75%, and Stagecoach, assuming this merger happened, we're looking at roughly a £2 billion company in terms of market capitalization, and this could be well placed to continue to grow in the longer term future. Shares in the last year have been pretty stagnant since I last mentioned this, and in fact, obviously if you'd have bought just before my video, then you might have done quite well. But then if you'd have known with your crystal ball to sell out during December or in the start of 2021, then you likely would have made some money. Perhaps at the moment this could be a good position for long-term value. It's still significantly discounted to the pre-pandemic, although I may be wrong. They may have done some forms of dilution back then, although I'm not entirely sure, and this is speculation. The company, I think, has some potential here for growth, not one that I personally want to be invested in, but it does check off my criteria. It is an easy to understand business. I could explain this to a 5-year-old and they would understand it. It is something where you could predictably see the earnings scale, and obviously they can reinvest a lot of their money back into the business, but also grow a dividend if you're interested in a dividend income. This stock, as I've said before, I believe is fairly recession proof, providing on what kind of recession we've got going. If it's a black swan pandemic event, at least they're going to be better prepared for it, although that seems like a once in a 100-year event, and obviously very unlikely. If you're interested in my Argo blockchain stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a fantastic day.